Now, let us translate the learning of production into a coherent understanding of costs. This is the most important thing for you to understand to run the business. Till now, we have established the relationship between the quantities of inputs employed and the corresponding level of output. In this section, we will forge the link between the quantity of output produced and the cost of producing it.
Our first step will be to tackle the question of how cost structures vary with output in the short run. There are 7 different types of costs to keep track of: total cost, variable cost, fixed cost, marginal cost, average total cost, average variable cost, and average fixed cost. Let's start the discussion. A given quantity of output, say bookshelves, can be produced in many ways. As a business owner, we need to find the cheapest way, the most appropriate method for existing input prices. Total cost of production can be broadly classified into 2 categories: fixed costs, variable costs. Fixed costs are costs that are necessary to be incurred for any production to happen, but are not directly linked to additional production. Variable costs are the costs that need to be incurred in direct proportion to the output. Let's understand this intuitively first. Consider that you wish to go to a bookshop to buy books. Now, from cost perspective, there is cost you incur for going to the shop and returning, that is, possibly taxi charges or your motorbike petrol charges. And then there is cost you incur for buying the books. The expenses you pay for going to the shop have necessarily to be incurred in order to achieve your objective of buying books. And even if you decide not to buy any book, that cost is incurred. This is the fixed cost. The books that you buy, you pay only for those you buy. In other words, the costs you incur in purely buying the books are directly linked to the numbers and titles you buy. This is variable cost. To see how costs vary with output in the short run, it is convenient to begin with the simple production of bookshelf example we discussed earlier. The total cost of producing the various levels of output is simply the cost of all the factors of production employed. Let's first see the cost of fixed inputs for the firm, that is, fixed cost. If we own our own capital, its implicit rental value is an opportunity cost. The money that could have been earned if we had sold our capital and invested the proceeds in, say, a government bond. Suppose our capital is fixed at 120 machine hour per hour, the rental value of each of which is R is equal to $0.25 per machine hour. So for utilizing our total capital for 1 hour rental will be $30 per hour. This cost is fixed cost, which means that it does not vary in the short run as the level of output varies. More generally, if K0 denotes the amount of capital and R is its rental price per unit, we have FC is equal to RK. Other examples of fixed cost might include property taxes, insurance payments, and interest on loans. Now, let's see the cost of variable inputs, that is, variable cost, VC. It is defined as the total cost of the variable factor of production at each level of output. To calculate VC for any given level of output in this example, We simply multiply the amount of labor needed to produce that level of output by the hourly wage rate. Suppose labor for producing bookshelf is purchased in the open market at a wage rate. W is equal to $10 per person hour and capital is fixed in the short run. Thus, the variable cost of 27 bookshelves per hour is $10 per person hour multiplied by 3 person hour per hour is equal to $30 per hour. More generally, if L1 is the quantity of labor required to produce an output level of Q1 and W is the hourly wage rate, we have VCQ1 is equal to WL1. Note the explicit dependence of VC on output in the notation on the left-hand side of equation, which is lacking in equation of cost of fixed inputs. Let us now find the total cost, TC. Total cost is nothing but the sum of FC and VC. If we wish to produce 43 bookshelves per hour, the total cost of doing so will be $30 per hour plus $10 per person hour multiplied by 4 person hour per hour is equal to $70 per hour. More generally, the expression for total cost of producing an output level of Q1 is written TCQ1 is equal to FC plus VCQ1 is equal to RK0 plus WL1. Table shows fixed, variable and total cost for corresponding output levels for the production function. The relationships among the various cost categories are most clearly seen by displaying the information graphically, not in tabular form. So, let's do that.